$500,000. Same age, same amount, same plan. One man runs out of money in his mid-70s. The other ends 30 years later with more than $1 million still in the account. They are Robert and James. Robert retired at 65 in 1966, James at 65 in 1982. The only difference between them was the calendar year they stopped working. That gap did not come from smarter investing. Neither man timed the market. The difference was the order in which the market delivered its returns. I am going to show you the mechanics, walk through their actual decade-by-decade balance trajectories, and give you 5 specific moves to cut sequence risk. Before the 5th move, I want to flag one thing. Move 5 is the one most people completely miss because they are thinking about what to hold in retirement, not what to hold right now. Let me set the scenario so the math is fully auditable. Both Robert and James start with $500,000. Both use a 60-40 portfolio. 60% in U.S. stocks, 40% in 10-year U.S. Treasury bonds, with annual rebalancing. Both take out 5% of the original portfolio, $25,000, in year 1, then adjust upward each year to match actual historical CPI. The only variable is the retirement year, 1966 for Robert, 1982 for James. Stock returns use Damodaran's S&P 500 Total Return Series at NYU Stern. Bond returns use the 10-year Treasury Total Return Series from the same data set. This is not financial advice. That conversation belongs with a fee-only fiduciary who knows your specific numbers. Here is the arithmetic that every retirement presentation leaves out. I will apply end-of-year withdrawals after each year's return in both scenarios. Scenario 1. Bad first. Year 1. The market drops 30%. Your $500,000 falls to $350,000. You take your $25,000 withdrawal at year-end, $325,000 going into year 2. Markets recover with a 40% gain. 40% of $325,000 is $130,000. You are at $455,000 before the year 2 withdrawal. Take out $25,000. You end year 2 with $430,000. Scenario 2. Good first. Year 1, the market gains 40%. Your $500,000 grows to $700,000. You take your $25,000 withdrawal, $675,000 going into year 2. Year 2 falls 30%, $202,000 lost. You end year 2 with $447,500 versus $430,000 in the bad first scenario. Same 2 returns, same 2 withdrawals, different order. The good first scenario ends year 2 with a $17,500 advantage, and your going forward withdrawal base is larger every single year from here. Stretch that arithmetic over 30 years, and the gap does not just widen. It decides whether Robert runs dry or James doubles. Wade Pfau, one of the leading researchers in retirement income, put it directly. The returns in your first years of retirement carry far more weight than what comes later. When you are forced to sell shares in a down market to fund your living expenses, those shares are gone permanently. They cannot participate in any future recovery because they have already been spent. If you are within 5 years of retirement, think right now about whether your current allocation is built for accumulation or for withdrawal. Those are 2 different jobs. Now let us look at what this actually did to Robert. Robert retires in 1966 with his $500,000 and begins withdrawing. What did he walk into? The late 1960s and 1970s delivered one of the most punishing combinations in U.S. financial history: stagflation, slow economic growth combined with rapid inflation. The S&P 500 was essentially flat from the mid-1960s into the early 1970s. Then, in 1973 and 1974, the market dropped sharply, down roughly 14% in 1973 and roughly 26% in 1974, based on Damodaran's S&P 500 total return data. One of the deepest two-year drawdowns outside of the Great Depression. Meanwhile, inflation was burning through Robert's purchasing power. The Consumer Price Index rose at over 10% annually in 1974. By 1980, CPI was running at nearly 14%. What does that combination do to a retirement portfolio? It hits from both sides. Stocks falling means the portfolio is shrinking. Inflation rising means the withdrawal amount must increase every year. Robert was forced to sell more shares at depressed prices just to keep up. By year 5, around 1971, Robert had been selling into a market that had gone essentially nowhere since 1966, while inflation was eroding every dollar he withdrew. His portfolio was already meaningfully below its starting value, and the dollar amount he had to withdraw each year was rising because CPI had been running hot. He was behind, and it was going to get worse. By year 10, 1976, he had absorbed the 1973-74 crash, a two-year drawdown of roughly 14 and then 26% in consecutive years. Each year, he was selling more shares from a smaller pool at lower prices. The portfolio's capacity to participate in any future recovery was being permanently reduced with every forced sale. Fow's rolling period simulations and Benjamin's original SafeMax research identify 1966 as one of the worst starting years in the entire U.S. historical record, alongside 1929 and 1937. A retiree starting at 5% in 1966 faced portfolio depletion well before the end of a standard 30-year horizon in most historical simulations of this period. By the time the great bull market of the 1980s and 1990s began, Robert did not have enough capital left for the recovery to matter. Robert's account ran dry in his mid-70s, not because of a single crash, but because 10-plus years of selling shares into a stagnant, inflationary market had left nothing for the recovery to work with. James gets the same plan, but the calendar hands him the opposite sequence. James retires in 1982 with the same $500,000 and the same 5% starting withdrawal. The summer of 1982 was, in retrospect, one of the best moments in U.S. history to begin drawing down a retirement account. The Federal Reserve, under Paul Volcker, had just broken the back of inflation through a sharp recession. Unemployment reached nearly 11% in late 1982, but the reward was that inflation fell fast. By 1983, CPI was running below 4%. By the mid to late 1980s, it had settled into the 3 to 5% range. And then markets moved. The S&P 500 gained roughly 21% in 1982 and over 22% in 1983 using Damodaran total return data. Instead of selling into a falling market, James's portfolio grew meaningfully above $500,000 before his first withdrawal. He started year 2 from a stronger position than he started year 1. By year 5, entering 1987, James had been compounding for 4 consecutive strong years before the October crash arrived. That single-day drop of roughly 22% on the Dow was severe, but James was withdrawing from a portfolio that had already grown substantially from its $500,000 starting point. The crash hit a much larger base. His sequence cushioned it. By year 10, 1992, even after a decade of inflation-adjusted withdrawals, James's portfolio was materially above where it started. He was not just surviving. His margin of safety was widening every year. Fow's rolling period analysis identifies 1982 as one of the best starting years on record. Most historical simulations show the 60-40 portfolio not just surviving, but ending with a balance well above the starting amount. That is how James ended year 30 with more than $1 million. Same $500,000. Same plan. 16 years of calendar difference. Some of you are doing the math in your head and thinking, the lesson is I need to know whether I am retiring in a good year or a bad year. Pick the right time. That is not the lesson. Nobody rang a bell in 1966 to warn Robert. Nobody sent James a letter in 1982 saying this is the best retirement launch window in a generation. Both men made their decisions based on the same kind of incomplete picture you have right now. They retired when their circumstances allowed, when they hit 65, when their health changed, when the company offered a buyout. The real lesson from Robert and James is that sequence risk is a structural feature of retirement, not a market timing problem. You cannot solve it by trying to pick the right year, but you can absolutely reduce your exposure to it. Before I get to move 5, I want to flag something. Most people focus their sequence risk planning on what happens after they retire. Move 5 is about what to do before you retire. Here are 5 moves that meaningfully reduce sequence of returns risk. They come from the academic research in retirement income planning, not from guesswork. The first move: start with a withdrawal rate that gives you room to breathe. Robert started at 5%. That is above the safe max, the highest initial withdrawal rate that survived every tested 30-year window in U.S. historical data under Benjamin's assumptions. If Robert had started at 4% instead of 5%, his first-year withdrawal would have been $20,000 instead of $25,000. That $5,000 per year in reduced selling during the down years of 1967 through 1974 would have left meaningfully more shares available for any recovery. For a 40-year retirement, realistic if you retire at 60 and live into your late 90s, FAU's research shows the maximum safe rate drops further to around 3.72%. Knowing which scenario you are in before you decide on year 1 withdrawals is the most consequential planning decision most retirees make without enough attention. The second move: build a cash buffer before you retire. This is the shock absorber Robert did not have. Retirement income research documents that holding roughly 2 years of living expenses in cash gives you a spending runway before you are forced to sell equities. When markets drop, you pull from the cash bucket. Your stocks stay in place. You give them time to recover before you touch them. That buffer is not idle money sitting on the sidelines. It is sequence insurance. Robert's first bad year was 1966. If he had had 2 years of withdrawals in cash before he retired, he would not have had to sell a single share of a falling market until late 1968. Every year of selling you avoid at the bottom is a year of shares preserved for the recovery. The third move: make your spending flexible, not fixed. The deepest vulnerability in Robert's scenario was fixed withdrawals into a falling market. Every year of the 1966 to 1974 stretch, his plan mechanically forced him to sell more shares as markets fell. The alternative is a dynamic guardrails approach documented by financial planner Jonathan Guyton and others in the retirement income literature. The basic structure: you set a starting withdrawal rate, typically around 5% in the guardrails research, but you pair it with a spending rule. If your actual withdrawal percentage rises above a defined ceiling because your portfolio has shrunk, you cut your annual draw by 10%. When markets recover and your rate falls back below a defined floor, you restore it by 10%. Robert's plan could not bend. A guardrails plan could have cut his required withdrawal during 1973-74 and preserved the shares that never had a chance to participate in the 1982 recovery. The fourth move: Build your guaranteed income floor before you need it. Social Security is an inflation-adjusted, government-backed income stream that lasts as long as you live. Every dollar of guaranteed income is a dollar of portfolio you do not have to liquidate in a down market. Delaying from 62 to 70 can increase your monthly benefit by more than 70%, depending on your birth year and earnings record. The SSA's own projections confirm a benefit roughly 74% higher at 70 versus 62. That is a permanent, inflation-adjusted raise that reduces the portfolio withdrawal rate you need in exactly the years when a bad sequence is most dangerous. Whether delaying makes sense in your situation depends on your health, your cash flow needs, your spouse's benefit picture, and your break-even math. A fee-only fiduciary can model that for you. But the connection to sequence risk is direct. The higher your guaranteed income floor, the less you need to pull from the portfolio, and the less damage a bad sequence in year one can do. The fifth move: recognize that the sequence risk window opens before retirement day. This is the move most people miss. Your sequence risk window does not begin on the day you stop working. It begins roughly 2 to 3 years before retirement, per retirement income research. A major bear market in the final 2 years of your career, while you are still fully invested and planning your exit, can hit at exactly the wrong moment. Your account is at its peak. You have not yet built any cash buffer, and you are about to start withdrawing. If you're planning to retire in 2027 or 2028, the allocation question you need to answer right now is not what you will hold in retirement. It is what you should be holding today. Starting to shift some exposure towards stability in the final years before you cross the line is one of the most underused sequence risk moves in retirement planning, and one of the few you can act on before the damage starts. Robert and James took the same plan into 2 different versions of history. Here is the one thing the comparison reveals that most retirement planning conversations miss. James was lucky, but he did not win because he was smart about the stock market. He won because he was boring. He held a balanced portfolio. He took out a reasonable percentage. He did not panic in 1987. He did not panic in 1987 when the market fell 22% in a single day. He left the rest alone. The sequence did the work. March 2020 was the same dynamic in miniature. The S&P 500 dropped roughly 32% from its recent highs. Every headline was catastrophic. Some people sold. They locked in permanent losses right before one of the fastest market recoveries in U.S. history. The people who stayed, who just held on, captured the entire rebound. The difference was not information, it was behavior. Wade Pfau's work and the broader retirement income research community are consistent on this. Sequence of return risk is the central hazard of the distribution phase of retirement. It is what makes the first 5 years after you retire the most fragile years for your retirement portfolio. Not because markets are more likely to crash then, but because a crash in those years combined with withdrawals is the kind of damage that compounds forward. Robert did not fail because he was a bad investor. He failed because the calendar turned against him in the first decade, and his plan had no shock absorbers. James did not succeed because he was brilliant. He succeeded because his shock absorbers never got tested. Here is the rule the whole video distills to: protect the first 5 years from forced selling, and the next 25 become manageable. That means starting with a conservative rate, building a cash buffer before day 1, staying flexible enough to cut if markets fall, building your Social Security income before you need to draw on the portfolio, and starting the sequence risk shift 2 or 3 years before retirement, not on the day you hand in your badge. This is not financial advice. It is education. Take what fits your situation and walk through the specifics with a fee-only fiduciary who can model your actual numbers. If this changed how you think about the sequence problem, drop the word sequence in the comments. It helps me understand what topics are landing for people approaching retirement. If someone you know is getting close to retirement, send them this video. And if you found it useful, hit the like button before you go. See you in the next one.